Risk-reward ratio. Okay. First of all, we have the definition of risk-reward ratio. The risk-reward ratio measures how much your potential reward is for every dollar you risk. This definition can be found everywhere. In the classical view, in the past years, people were talking about a minimum of 2 to 1, and even that was not good enough. The golden risk-reward ratio, some people consider it to be 1 to 4. That means if you have a stop of 50 pips, your limit should be 200 pips, 4 times the stop, which is a lot. I mean, how many times you see the market move 200 pips in the same direction without fluctuating, you know? So the classical view has lost a lot of admiration in recent years. The modern view is towards lower numbers. A lot of professionals now believe even 1 to 1 is considered okay. And there's also the point of view that says that risk-reward ratio does not even mean anything on its own. Of course, if you have a great risk-reward ratio, but you have a limited accuracy ratio, you cannot make money in this market. Can this ratio make you miss profitable trades? Of course it can. If you are aiming to a high ratio like 1 to 4, that means when you see an opportunity in the market for any number of pips, your stop should be only a quarter of that potential profit. So first of all, day trading, a lot of people trade during the day. They don't keep their positions overnight for several reasons, and I'm one of them. So whatever the reason is, some people trade during the day and close and go home after closing their trades. And during the day, we do not expect, and we should not expect, the market to move beyond its average daily range. So average daily range for some pairs that are heavily traded could be 50 or 60 pips. So if I see an opportunity to capitalize on half of that, I see an opportunity in the market to make 30 pips. Can I go in? If I can go in and I want 1 to 4 risk-reward ratio, then what my stop should be 7.5 pips. And of course, when I see that, it can hardly cover the spread, so I stay away from the market if I want that. But if I use 1 to 1, okay, I can place my stop at 30 and my limit at 30 and get in, so I don't miss as much trades as if I follow the classical view. And also there's the question, what kind of stops can we use for small trades, or for small targets, which we had just talked about. If my target is 30, if my target is 40, my stop should be 10 pips. That's nonsense. That's nonsense. So if you stick to a very high risk-reward ratio, you will miss a lot of good trades and good opportunities to make 30 pips here, 40 pips here, 35 pips here, and these trades should not be missed. So what you should do is you should reconsider, if you are one of the people who think that risk-reward ratio should be very high, reconsider your numbers. And of course, there's the point that even if I get in and I have a target of 40 pips and a stop of 10 pips, it's very easy for the market to hit the 10 pip stop. And what will that do to my accuracy ratio time after time after time? If I 10 pips here, 10 pips there, 10 pips there. So at the end of the day, I may be losing 3 or 4 trades, all of them with 10 pips. And maybe the winner will make me 40 pips. The pips on each side are around the same, but the accuracy rate will drop significantly because I may lose 3 and win 1 in order to make money. Okay, we just said that risk-reward ratio means nothing without including the winning ratio in your calculations. And let me give you some examples about that. If you have an excellent risk-reward ratio, you can still make loss. How is that? Risk-reward of 1 to 3 means that if you use a stop of 50 pips, your targets should be 150. Let's say that you win 20% of the time, and with a target like 150, that's what you should expect. You cannot expect your winning ratio to be 90% and every trade you get in will make 150. So with a winning ratio of 20%, after 100 trades, you will make money on 20 and you will lose 80. On the winners, you will make 150 pips each, and on the losers, you will lose 50 pips each. The total of these numbers is a loss of 1,000 pips in 100 trades. Although you are using an excellent risk-return ratio of 1 to 3, you were not able to make money. Okay, the second possibility is an excellent winning ratio, but still you are making a loss. A winning ratio of 80% is considered remarkable, but if your risk-reward ratio is 1 to 1/10, and believe me, I've seen people follow that. You may say, who does that? A lot of people does that. How? They aim for 10 pips of profit and place their stops at 100 pips. So if you do this, even if you win 80% of the time, and of course with small targets, you can expect to win 80% of the time. If you win 80% of your 100 trades, that's 80 trades winning, 20 trades losing, you will end up with 1,200 pips of loss, although your winning ratio is extremely well. But without the need for great numbers and very impressive numbers in the risk-reward ratio or in the winning ratio, you can still make very good profit. How's that? Let's see how this modest risk-reward ratio and modest winning ratio can make me money. If I use a risk-reward ratio of 1 to 1.25, that means I aim for 50 pips, I place my stops at 40 pips. They are very close to each other. And I only have a winning ratio of 55%. You know what does that mean? It means if we trade 100 times, we expect to make money on 55 trades and lose money on 45 trades. 45 losing trades in 100. How can I make money from that? Of course I can make money from that, because the total for these numbers after 100 trades is a profit of 950 pips. So you see, an excellent risk-reward ratio by itself means nothing. An excellent winning ratio by itself means nothing. But combination of good numbers or even modestly good numbers on both sides can make you profit.